Hey, what's up everybody? It's your mortgage expert, Brian McCauley here. So are you a current homeowner? You bought a place in the last 24 months, you're looking to refinance your loan, and you're trying to figure out what's the best time, how does it all work, what's the expense, and who's gonna guide me through it. Stick around. In this video, I am gonna teach you everything you need to know about refinancing. So the DFW housing market is picking up once again. As interest rates continue to drop, people are looking for the best deal out there. They're trying to figure out when the best time is to buy, when the best time is to refi, when the best time is to put everything off. And so I want to make sure in this video that I do an excellent job to talk about the refinance market. You know, I've been doing this for 19 years. I started my career doing refinances for probably the first 9 and didn't do a whole lot of purchase transactions until I expanded my business with realtors, CPAs, divorce attorneys, a lot more people that needed the purchase market. However, refinance booms happen probably once every 7 or 8 years when it comes to the market. Refinance boom is on the horizon. People are starting to figure out, hey, I bought a house a couple years ago. I got a great price on the house. I finally got one that I could, like and find and fix up, but I had to take a higher rate in the meantime. We've talked about strategy where sometimes taking a higher interest rate to get a price on a property that they like and refinancing later is actually one of the smartest moves. We say date the rate and marry the house. Well, at this point, there are a couple people that have been in their house for anywhere from, let's call it 9 to 18 months, maybe 24 months. So I want to talk in this video and give you specifics on refinances, on how does it work, when is the right time, what is the cost, what is the process, and what to expect from start to finish. Okay, so refinances again are about saving money for the consumer. It's not necessarily about the rate, it's not necessarily about the payment, it's not necessarily about the cash out, shortening the term. There are a lot of things that people can benefit from on a refinance. Now, the mainstream thought behind this is rate and payment. Of course, that's a big one, but I want you to expand your refinance box and think about what is the net tangible benefit to the consumer. Meaning, if they refinance, why would they refinance? What are the benefits that they could get? And is this enough, right? Is it the right time to do it? Is it the best way to do it? Should they wait for longer? These are things we're gonna walk through. So the most common thing to consider when people are refinancing is to get a better overall lower payment. Sometimes that is when you can lower the rate. Sometimes you can get rid of PMI. There are a whole host of things, but I think people should consider a very easy thing is, if you can decrease your interest rate by minimum of 1%, that is almost always a given of a starter why people should consider a refinance. Now, there are a lot of things out there that affect the bottom line on the payment, the affordability, the net tangible benefit outside of the rate, but let's just start with the actual rate. So we'll use 1% as a rule of thumb. If you can get better than 1%, maybe 1.5% or 2%, depending on when you bought, that obviously is a big benefit to the consumer, and I think that's something they should consider. The two other things that I always like to consider is when people are payment sensitive and they want to lower payments, they get hyper-focused on the interest rate, which obviously is important, but another component about this that I want to talk about on part 2 is private mortgage insurance. So on conventional loans, people have this misnomer of, hey, I have to have monthly PMI unless I get to 20%. Well, that's not always the case, and it's obviously not the case with FHA, and it can be a benefit to switch off FHA to get on conventional. So let's talk about part 2. Part 2 could be PMI, right? Private mortgage insurance. And so the way that's established is when somebody buys a house, if they put 5% down, 10% down, 15% down, the more money that somebody puts down between the 0% and 20%, the higher the PMI. And so if somebody has lived in a house for the past 12 months, 18 months, and they've constantly gained equity, they may be already at a 20% equity position. So let's say somebody has a 799 rate and they want to refinance to a 699 rate. They've had that property for, let's call it 18 months. They put 10% down. Maybe they've got PMI of $150 right now, if they refinance to lower the rate from $799 to $699, that could save them a couple $100 in payments. However, they bought their house 18 months ago, and obviously with interest rates dropping, property values are starting to increase again, they may be currently at a 20% equity position. So not only would that homeowner benefit from lowering their interest rate to save them money in the payments, if they're at a 20% equity position on their conventional loan, now that extra couple $100 a month on PMI automatically falls off as well, because now they're at 20% equity. Then what you do is take the combination of just the interest rate, which people look at in the beginning, now a combination of the PMI, you marry the two together, and sometimes that could be an extra $400 or $500 a month in savings. So those are two easy ways. The third one is converting the loan structure and the loan type. What do I mean? Let's say somebody has an FHA loan. They've had an FHA loan for 12 to 18 months. Maybe the interest rate is, again, $699, but FHA has monthly private mortgage insurance. If somebody's in a position now where they don't have to take an FHA loan on a refinance, they may refinance it to a conventional loan, which may or may not have a better interest rate. At this time in the market, it probably does, but FHA has monthly PMI for life. Conventional doesn't. So if somebody is at a $699 on an FHA, but it's got monthly PMI, maybe they refinance to a conventional that's maybe only 6.25. So it doesn't feel like a lot of savings in just the interest rate alone. But if you get rid of the FHA forever PMI and get a conventional loan again that has no monthly PMI, it would be a net tangible benefit to the client to not only save money in the interest rate, but obviously save money in the PMI as well. Those are just some additional thoughts on why people refinance. You know, a third big component of refinances is, cashing out, right? A lot of people bought their house 12 to 24 months ago. They've got some equity in it. The market's starting to go up. Maybe they've got 20, 30% equity. And what they're doing is saying, hey, Brian, I bought my house 2 years ago. I've got a 7.99 interest rate. I want to refinance now and maybe take 5, 10% extra cash out because I want to pay off some debt. Yes, my mortgage balance may go up slightly. My interest rate's probably going to drop a tad because obviously rates are continuously getting better. But the savings is not just in the interest rate and the payment. Now they've got some extra equity. They want to tap into it. Maybe they pull out $10,000, $15,000, $20,000 in cash. And let's say they've got a car payment. Let's say they've got a credit card payment. If you take some of that cash out of your property and you pay off other bad debts, and that eliminates, $400, $500, $600 a month, then all of a sudden you've done a cash out refinance where the interest rate may be not as competitive as you want and it's not saving you strictly enough money on the mortgage payment itself. But if you're tapping into the equity that's now available in your house and you're using that to pay off other debts, what happens is you get what's called a compounding effect, right? The compounding effect is the savings on the mortgage payment itself, but obviously taking cash out and paying off some other debts. When you combine those two monthly improvements together, now you're in a more positive position of $400, $500, $600 a month. And so obviously cash outs are very advantageous. Last but not least, there are reasons that people refinance outside of rate, outside of payment, outside of PMI, outside of cash out, is to shorten the actual term. So let's say somebody got a 30-year mortgage and it was at $799. Maybe in the next 6 months, rates get down to $599. They want to refinance, but they don't want to start the term over. So they say, hey, Brian, let me take this $799 rate, refinance it to a $599 rate, but I'm already 2 years into my loan. I don't want to go backwards and reset from 28 years to 30. What about if I refinance on a $599 rate and just take a 25-year note? Maybe I can do a 20-year note where my mortgage payment might go up $100, but I'm cutting 8 years off the mortgage. Or they do a 25-year, which is, hey, I can keep my payment the exact same, but I'm going to cut 3 years of interest off the note. So remember, you can do a 30-year, you can do a 25-year, you can do a 20-year, you can do a 15-year. All of these are availabilities that people can look at depending upon their financial position. But for me, it's all about what's the highest and best use and structure of the refi. It's not always about the rate. It's not always about the PMI, not always about the payment. These are variables that help the consumer ultimately get to the end goal. But depending upon your unique situation, this is where you have to look at the analysis to figure out what's the total savings, how to structure it and make things work. Last but not least, I want to talk about refinance closing costs. There's a big confusion around this on how it works in the break even. People think it's much more expensive than it actually is. So I want to separate this into two parts, but make it really clean and easy. Refinances are very similar to a purchase. the closing costs are similar to a purchase as well. They're probably about 75% of the actual cost. Now, I want to remind everybody, the simple math on refinances is not, hey, if I'm refinancing a $500,000 loan and it cost me, $7,000 on a refi and I'm only saving $200 a month, that doesn't make a lot of sense, Brian. I don't want to spend $7,000 to save $200. So the formula to actually know what the real cost is if you're refinancing and it costs you $7,000, number one, there are traditionally no out-of-pocket expenses. You get to roll all of the refinance into your home loan. So let's say you have a $500,000 loan, your house is worth $600, you want to refinance the $500, and the closing costs are $7,000. Effectively, you would obviously roll it in and be financing $507,000 in, but you'd roll it into the balance. There'd be no out-of-pocket expense. But from a break-even standpoint is, traditionally you get to skip 1 month's payment, sometimes two, but let's use one just to be safe. So let's say you've got a $500,000 mortgage. Let's say your payment right now is $4,000. It's costing you $7,000 on a refi, and you're saving $200 a month. Okay. The way to do the math on this is, hey, it's costing me $7,000 to refinance, but I'm actually skipping an entire mortgage payment when you refi. So let's say you refinance and close in month A. Obviously, there's no payment there. You skip the following month, and the payment starts again in arrears on the following month. So if your mortgage payment was $4,000 and it cost you $7,000 to refi, your $7,000 to refi, your $4,000 payment. So effectively, it's costing you $3,000 to refinance. Okay, if you were saving $200 a month in the payment, what you would do is take the $3,000. Divide it by 200, and then a number will pop out. Whatever that number is, that is the amount of months it will take you to get that money back. And the simple logic behind this is that's your break-even point. If it says, hey, it's the number's 14, right? That means it's going to take you 14 months on the new mortgage to make up that lost equity. If you're for sure that you're going to stay in that property for longer than 14 months, do the refi. You're going to break even, and obviously after that break even point in that month, you'll start to make up whatever the savings of the monthly and the new home loan is. If you're not going to do it, or you're not sure that you're going to stay in the property for the break even point or how long it's going to actually take, don't do it because you'll lose equity. So that's something, again, I'll go over with consumers on when I do the strategy, but this is how you do the simple math on the break even point. Now, underlying piece that a lot of people don't pay attention to is escrows. God, this is a big one, and I don't want to get too detailed, but it's important. So most people know when you close on a property, you have a prepaid escrow account. So if your closing costs are $7,500, you have to prepay your homeowner's insurance when you purchase a house, and then the lender is going to collect 3 months of taxes, 3 months of insurance, blah, 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 all these things. So that prepaid escrow account is normally like $2,500, maybe $3,000. The same thing applies on a refinance if you want to include your taxes and insurance the second time around, but from apples to apples, I want to make sure and do it. From just a simple comparison. So if the closing costs in this deal are $7,000, and you have to up your insurance for 12 months, and you have to collect all the property taxes, obviously the prorated part through the rest of the year, that's a big chunk. That might be $2,500. Well, if you're refinancing hypothetically in the middle of the year, and you've already paid into your lender 6 payments of insurance, 6 payments of taxes, when you refinance that old note, that escrow money that's sitting in your account with your current servicer that's supposed to be used for taxes and insurance, when it's being collected on a new refinance, again, they're double dipping. So what happens is you as the consumer, any of the escrow balance and what I call the surplus is going to be refunded back to you in full within 30 days of paying off the new loan. So now you have to look at, oh, okay, well, it's costing me $7,000 for a refinance. But let's say $2,000 of that is your escrow account that you're having to set up again through the new refinance. And let's say you've got $2,000 sitting over here in your old escrow account you've been making payments on. So it's $7,000 for the total cost of the refi, but $2,000 of that is going to be an escrow refund that you get back in the mail. So now that puts you down to actually $5,000 as the hard cost. And then if you skip a month's payment of $4,000, $5,000 minus 4, now it's $1,000. And that's the actual true cost of the transaction. So if it's $1,000 for the actual true hard cost, which is the total closing cost minus the escrow refund minus the skip payment, is the actual cost. You divide that by the savings of the monthly. So now if it's $1,000, you're saving 200. You divide those into each other, that's 5. What that means is, hey, it's gonna take me 5 months to get the money back. If you're obviously gonna be in that mortgage for 5 months or longer, do it. If not, don't do it. Now, last but not least, what a lot of people like doing is what I mentioned in the beginning of this video is, hey Brian, I want to roll all my closing costs into the loan. I want to skip a month's payment, so I put $4,000 in my pocket. I'm going to get an escrow refund check for $2,000. So together, I'm keeping $6,000 in my pocket. Yes, you're going to save me $200 on the mortgage, but I've got a credit card over here that's got an $8,000 balance, and the monthly payment is $200. So what I'm going to do is take that $4,000 from my skip payment and that $2,000 from my escrow, and I'm going to pay that credit card balance down. So now instead of having an $8,000 credit card balance with a $200 payment, now I have a $2,000 credit card balance with a $50 payment, and I just saved them an extra $150 on their overall debts because we saved them $150 on the credit card, $200 on the mortgage. Now obviously it's the same as savings of $350, and it makes even more sense for the client. Sometimes people take that extra money and put it in the bank. Sometimes people will take that and pay off other debts. Sometimes people will take that money and use it for repairs or renovations on a house, put in a new fence, paint a wall, put in some carpet. So there are a lot of ways to do what I call compound and combined savings. But refinances, for the most part, end up being a no-brainer for the client. It's all about net tangible benefit, savings on rate, payment term, PMI, and loan product. Now you know exactly how refinances are structured. Now you know the break-even point. And last but not least, refinances are easier on paperwork than they are on a purchase. On a purchase, they want full assets, usually 2 years of employment, all these things. Majority of refinances don't need a full appraisal, don't need full income, maybe 1 year, only need some assets. And so it's a lot easier transaction on the buyer as well. It's just a matter of updating the financials, updating the credit score, making sure that majority of your stuff is still in line, because obviously we're gonna make sure that you're still paying your bills, still have a job, but it's limited income documentation, limited appraisal, it's limited. So it's about 60 to 70% of the cost, it's about 60 to 70% of the paperwork, and it's all about timing, and it's all about net tangible benefit to the client. So hopefully this has been helpful to you, and now you have a full understanding of when you should refi, how you should refi, what it takes, what the cost is, and what the break-even point is. So I hope you found this refinance video useful. If you did, do me a favor, like, comment, subscribe. If you got questions about refinances, drop a comment below, or feel free to share this to anybody that you know. And if you just want to have a conversation around refinancing, pre-approvals, the state of the housing market, or just see where things are headed in 2024, to set a consultation with us, reach out to us, call us, email us, text us. We are always here for you. Until next time, stay tuned.